morning, everyone. I've got two main aims this morning. First of all, I want to find out why that spider's got 9 legs. Second of all, I'm going to try and not fall off this box that they're making me stand on. You'll have heard lots of Halloween puns this morning. I'm not getting roped into any of that nonsense. I think it would be a grave mistake. Moving swiftly on. In his recent letter to the Chancellor, Tom Bradshaw, who is the President of the National Farmers Union, said the following: "Let me be clear, changes to agricultural property relief and business property relief would be a devastating blow to British farming as we know it, the effects of which will be felt for generations to come. These reliefs are critical components of the inheritance tax strategies of many of our clients. And so when the Chancellor announced changes to agricultural property relief and business property relief, or APR and BPR, I knew that we certainly had pumpkin to talk about." So a quick reminder of the current IHT rules. Individuals get a nil rate band worth £325,000, plus up to a further £175,000 residence nil rate band if you are leaving a home to your direct descendants. If you don't use them, these allowances are transferable to your surviving spouse. Residence nil rate band can be restricted for estates worth more than £2 million, but otherwise a couple will have £1 million of IHT exemptions available between them. On top of that, the amount of APR and BPR is currently unlimited and often applies to give 100% relief for qualifying assets. No changes were announced to the nil rate band or the residence nil rate band, and these reliefs are still transferable between spouses. However, the government announced that they will reform APR and BPR from April 2026. For deaths from this date forward, it will only be the first 1 million of combined business and agricultural assets that will continue to attract no inheritance tax at all. Importantly, if it is not used, this 1 million allowance is not transferable to a surviving spouse. For assets over the 1 million threshold, and for all AIM shares, relief will only be available at 50%, so an effective IHT rate of 20% for those assets. The government claims that 3/4 of APR claims will be unaffected by these changes. I suspect there are quite a few people in this room and watching online who would disagree with that. Assets where the APR or BPR rate is already 50% are not affected by these changes. So let's look at the impact for a family that's built up wealth of 3 million that they want to leave to their kids. Currently, if everything is left to spouse on first death, the IHT on the second death is 140,000. From April 2026, this figure increases by £200,000. It is worth pointing out that in both cases, careful planning on the first death could ensure that the IHT liability is reduced to nil. But to achieve this, particularly now, lots of wills are going to have to be rewritten to ensure that assets are passed down a generation by both parents and not just on the second death. Where property is held in a discretionary trust, inheritance tax charges of up to 6% apply on each 10-year anniversary and when property exits the trust. In many cases, APR and BPR apply to reduce the taxable amount in the trust to nil, irrespective of the market value of the property. From the 6th of April 2026, the restricted 1 million APR and BPR allowance will also apply to trusts, with anti-avoidance provisions ensuring that the 1 million allowance is divided up where multiple trusts are created. The effect on trusts of reducing APR and BPR to 50% on qualifying assets over the million could be significant. For example, a trust holding £10 million of qualifying shares will see its 10-year charge increase from £0 to £270,000. For trusts that have only got shares or property in them and are cash poor, careful thought will need to be given as to how these 10-year charges are going to be financed. These changes don't come in until April 2026, though. Oh, I nearly went then. So what should we be doing in the meantime? Well, we can make lifetime gifts, although anti-forestalling rules have been introduced, which mean that the new APR and BPR rates will apply on gifts made from today. Transfers made more than 7 years before death will continue to fall outside the scope of IHT in the normal way. Families will need to therefore think about whether they should start gifting and get that 7-year clock ticking, being mindful of capital gains tax, of course. I've already mentioned, but I'll say it again, it is critical that wills are reviewed to ensure that the 1 million APR BPR allowance is also claimed on first death, as it is not transferable. You might also want to take out some kind of IHT insurance. There are loads of different policies available, and sometimes these can be paid tax efficiently by family companies. And if all else fails and there's still IHT to pay, the option to spread the payments over 10 years remains available, with interest, of course. So, inheritance tax on pensions. Well, the first pension schemes were introduced in the 1950s. And they were never intended to be vehicles for inheritance tax planning. So for me, the surprise in this particular announcement is that it has been so long in coming. There's really not much to add to the slide here. With very few exceptions, most pension pots will now be included in a deceased estate for IHT purposes from the 6th of April 2027. It will be the pension scheme administrators who would be required to report and pay the inheritance tax attributable to the pension savings, and the IHT will be paid directly from the pension pot itself. We've got a really simple case study here. This assumes the deceased was a single unmarried person with no kids, so just one nil rate band available. At the date of death, personal pension pot of 700,000, rest of their estate worth 800,000. Under the current rules, the pension pot is outside the IHT estate, IHT liability therefore 190,000. From April 2027, pension pot inside the inheritance tax estate, the bill goes up to £470,000. We can see that the total liability is prorated between the pension element, which is payable by the pension scheme administrator, as I said, and the rest of the estate, and that's paid by the deceased personal representatives in the normal way. As pension funds can now be subject to up to 40% IHT, I think it's fair to say that we'll probably now see greater withdrawals from pension funds going forward. Pension income can be used to make gifts out of surplus income to your children and grandchildren, which would once again take the money outside the scope of IHT. Taking uncrystallised pension lump sums and gifting these to the next generation also has the potential to get large sums out of the IHT net, as long as you survive 7 years from the date of the gift. And finally, stamp duty land tax, or SDLT. There were no immediate changes to the standard SDLT rates, with both the residential and non-residential rates remaining exactly the same for the next 5 months or so. It was previously announced that these will increase from the 1st of April 2025, and that includes relief for first-time buyers relief. The big SDLT announcement was an increase in the surcharge rate from 3% to 5%. This rate applies on top of the standard SDLT rates for purchasers of second or additional dwellings, and it also applies to all corporate purchasers. The government will also increase the single rate of SDLT paid by companies acquiring properties worth more than £500,000. This rate is up from 15% to a whopping 17%. We can see from the slide the impact of these changes. SDLT on a second home worth 250 grand would have cost you £7,500 yesterday. In a few months' time, that will have doubled to £15,000. The SDLT on an additional dwelling priced at £1 million has increased by £20,000 overnight. What this means is that SDLT planning is now more important than ever. I'm running out of time. I don't have time to talk through this example in detail, but suffice it to say that in this case, some simple SDLT planning would have saved the purchaser £16,000. For individuals who have inherited property, who've got a holiday home abroad, people who are trying to get on the property ladder with help from their parents, or people who are approaching retirement and wanting to downsize and get a buy-to-let, all of these people are potentially affected by the increase from 3% to 5%. So please do get in touch if you would like to talk through an upcoming property purchase. I should mention that these SDLT changes apply from today, but for the majority of purchasers who have already exchanged, the lower 3% surcharge rate will continue to apply even where completion happens after the budget.